What if I told you there is one investment that the smartest people in the world, billionaires, professors, Nobel Prize winners, all say most people should use? And it takes about 10 minutes to set up, costs less than your Netflix subscription to own, and has made regular people millionaires, not through luck or timing, just through patience. It is called an index fund, and by the end of this video, you will understand it so well you could explain it to your younger sibling over dinner tonight. Let me guess what has happened when you tried to start investing. You typed "how to invest" into Google or YouTube, and within about 30 seconds, you were reading about stock tickers, PE ratios, earnings per share, portfolio diversification strategies, and whether the Federal Reserve's monetary policy is going to affect your asset allocation. And you closed the tab because it felt like everyone who invests already speaks a different language, and nobody offered to teach you the basics first. Or maybe you did try to start. You opened a brokerage account, you looked at the list of available stocks, and you froze because there are thousands of them. Apple, Tesla, Amazon, Google, some company you have never heard of. Where do you even begin? How do you know which company is going to do well? What if you pick the wrong one? What if you put your money into something and it just disappears? This is the exact moment most people give up. Not because they are not smart enough, not because they do not want to build wealth, but because nobody made it simple first. That is what this video is. Simple first. Everything else later. Okay, let me explain what an index fund actually is. But first, I want to give you a problem to think about. Imagine you are at a food festival. Hundreds of food stalls, all different. Some are amazing, some are terrible, some will be packed all day, some will close before lunch. Now someone tells you, you have to pick one stall to invest your money in. If you pick the right one, you could double your investment by end of day. If you pick wrong, you lose everything. That is what picking individual stocks feels like. It is a bet on one stall, one company, one outcome. And even professional fund managers, people who do this full time for decades, get it wrong more than half the time. Now, here is what makes an index fund different. Instead of picking one stall, an index fund says, I am not going to pick. I am going to own a tiny piece of all of them. An index fund is a single investment that automatically owns a small piece of hundreds or even thousands of companies at once. When you put money into an index fund, let us say a global index fund, you instantly become a tiny part owner of companies like Apple, Microsoft, Amazon, Nvidia, Samsung, Nestle, HSBC, Toyota, and hundreds more, all in one purchase, all for roughly the cost of one share. So when the global economy grows, when companies across the board make more money, hire more people, sell more products, your index fund grows with it. Not because you picked the right company, because you own a piece of the whole thing. Now let me give you the simplest possible explanation of where the name comes from. A stock market index, like the S&P 500 in the United States, or the TSX in Canada, or the FTSE 100 in the UK, is basically a list of the biggest, most traded companies in that market. An index fund simply tracks that list. Whatever is on the list, the fund owns. If a company grows and becomes more valuable, its share in the fund grows. If a company shrinks or gets replaced on the list, the fund adjusts. No human is picking stocks. No fund manager is taking big bets. The fund just follows the index, quietly, automatically, every day. And here is why that matters more than most people realize. When a human fund manager picks stocks, they need to be right consistently to beat the market. And this is genuinely, surprisingly hard. Research shows that over any 10-year period, roughly 85 to 90% of actively managed funds, the ones where paid professionals are picking stocks full-time, perform worse than the simple index. Not some of the time, most of the time. Warren Buffett, one of the most successful investors of all time, has publicly said that for most ordinary people, a low-cost index fund is the best investment they can make. He has said it repeatedly across decades. He bet $1 million on it against a hedge fund and won. If the person who has spent 60 years picking stocks tells you not to pick stocks, maybe that is worth listening to. Now, let me quickly cover the two types of index funds you will actually encounter, because they sound similar but work slightly differently. Type 1, Index Mutual Funds. This is the original version. You invest a set dollar amount, say $100, and you buy into the fund at the end of the trading day at whatever the price is at that moment. Simple, straightforward, works great. Type 2, ETFs. Exchange Traded Funds. An ETF is essentially the same thing, a fund that tracks an index, but it trades on the stock market like a regular share. You can buy it anytime the market is open, at whatever the current price is. For most beginners, the practical difference is small. Both can track the same index. Both can perform similarly over time. The main things to compare are the fees. More on that in a moment, and what platform you are using. In Canada, the most popular index ETFs are XEQT and VEQT, both globally diversified, both low cost, both simple. In the United States, VTI is one of the most widely recommended, total U.S. market, extremely low cost, enormous track record. Globally, there is VWRA and similar options depending on where you are. You do not need to memorize all of these right now. The point is, they exist, they are accessible, and they are not complicated once you know what to look for. Let me show you what happens when you actually put money into an index fund. Take the S&P 500, the index tracking the 500 largest companies in the US. Since it was formally tracked, the S&P 500 has returned an average of roughly 10% per year. Before inflation, closer to 7 to 8% after. Not every year. Some years it goes up 25%. Some years it drops 30%. But over long periods, 10, 20, 30 years, the average has held around that number. Now let me show you what that looks like in real money. Person A starts at 22, invests $200 a month. $200 a month into a global index fund, 8% average annual return. By age 32, 10 years in, $200 times 120 months equals $24,000 contributed. With compound growth, approximately $36,000. Already $12,000 more than you put in. By age 42, 20 years in, $48,000 contributed. With growth, approximately $115,000, more than double without adding a cent more. By age 52, 30 years in, $72,000 contributed. With growth, approximately $272,000. By age 62, 40 years, $96,000 contributed. With growth, approximately $596,000, nearly $600,000, from $200 a month. Starting at 22, that is index fund investing. Nothing exotic, nothing clever, just time and consistency. Now, one thing you absolutely need to understand before you invest in anything, index funds or otherwise, is fees. Every fund charges a fee called the expense ratio. This is the annual percentage they take from your investment to run the fund. An actively managed fund, where a human is picking stocks, might charge 1.5 to 2.5% per year. A good index fund, like XEQT, VTI, or VEQT, charges 0.2% or less. That sounds like a tiny difference. It is not. On a $100,000 portfolio, active fund at 2%, you pay $2,000 per year in fees. Index fund at 0.2%, you pay $200 per year. Over 30 years, that fee difference alone compounds into tens of thousands of dollars that either stays in your pocket or goes to the fund manager. Low fees are not a bonus feature. They are one of the most important things to check before you invest in anything. Here is exactly how to start. 4 steps. Step 1. Open the right account. This is not optional. The account type determines whether your gains are taxed or not. Getting this right at the start saves you significant money over your investing lifetime. In Canada, open a TFSA, tax-free savings account. Every dollar your index fund earns inside a TFSA is completely tax-free. The gains are yours. The government does not touch them. In the United States, open a Roth IRA. Same principle. You invest after-tax money, and all the growth is tax-free when you withdraw in retirement. For either account, use a simple, low-cost platform. In Canada, Wealthsimple or Questrade are the most beginner-friendly. In the US, Fidelity, Vanguard, or Schwab. Step 2. Choose your index fund. One fund, not 10. One. In Canada, XEQT or VEQT. Both track the global market, both low cost, both excellent for long-term investors. Either one works. In the US, VTI for the total US market, or a target date fund if you want something that automatically adjusts as you get older. Do not overthink this step. The difference between two solid index funds over 30 years is usually smaller than the difference between starting today versus waiting another 6 months. Start. Then optimize later if needed. Step 3. Automate your contribution. Set up an automatic transfer from your bank account to your investment account every month, on the day after payday. The amount does not matter as much as the consistency. $50 a month automated is worth more than $500 whenever you remember. The psychology here is important. When the transfer is automatic, when you never see that money in your spending account, you do not make a decision about it every month. You do not talk yourself out of it when things are tight. It just moves, quietly, every month, every year. Step 4. Do not touch it. This is the hardest step, not because it requires skill, because it requires you to ignore your instincts when the market drops, and the market will drop multiple times over your investing lifetime. It will go down 20%, 30%, sometimes 40%. Every single time this has happened in history, it has recovered. Every single time. The people who lost money in index funds are not the ones who invested and held. They are the ones who invested, watched the market drop, panicked, sold, and turned a temporary loss into a permanent one. Do not be that person. Set it up, automate it, leave it alone. Here is the reframe I want you to walk away with. Most people think investing is about being smart, about timing, about research, about knowing which company is going to win next year. Index fund investing is the opposite of that, and that is exactly why it works. It is not about predicting the future, it is about owning the future, all of it. So it does not matter which specific part of it wins. When you own an index fund, you are not betting on one company. You are betting on human progress, on the idea that companies will keep building things, people will keep buying things, economies will keep growing over long periods of time. That is a much safer bet than, I think this one company is going to do well. You are not trying to beat the market. You are becoming the market. And the beautiful part? You do not need to be smart to do it. You do not need a finance degree. You do not need to read earnings reports. You do not need to watch the news every day. You need a phone, a bank account, and the patience to leave it alone. I want to leave you with this. The reason most people do not invest is not that they do not have money. It is not that they are not smart enough. It is that someone made it seem more complicated than it is. Index funds are one of the most powerful wealth-building tools available to any person at any income level. They have been for decades. They have been the open secret of the investing world. Available to everyone, used by the wealthy, explained poorly to everyone else. Consider this your explanation: a global index fund, a TFSA, or Roth IRA, an automatic monthly contribution. a long time horizon, and the patience to not touch it when it gets scary. That is the whole thing. That is the complete strategy. Not a step in the strategy, not the beginning of a more complicated plan. That is it. The people who will be financially secure in 30 years are not the ones who found the perfect stock or timed the market perfectly. They are the ones who started simple, stayed consistent, and let time do what time does when you let it. Drop a comment below and tell me honestly, have you started investing yet? If yes, what platform are you using and what fund are you in? If no, what has been the thing that has stopped you? Knowledge? Platform? Just not knowing where to begin? Tell me your situation and I will give you a specific, real answer. Not a generic response. Your actual next step. If this video finally made index funds click for you, share it. Share it with the person in your life who keeps saying they want to invest but does not know where to start. Sometimes all it takes is one clear explanation at the right time. Subscribe to Nuella Invests. Every week, we cover the financial moves that actually change where you end up. Simple, real, no jargon. I will see you in the next video.